What if I told you that the $50,000 plus new cars everyone's been buying could be worth 10%, 20%, or even less in just a few months? Sounds crazy, right? But buckle up, because the stage is being set for a major crash in new car prices. Today, we're explaining exactly why that's about to happen. Real data, real risks, and how you could capitalize on it. Whether you're thinking of buying soon or just watching the market, this is going to blow your mind. What got us here? The backstory. 1. Pandemic madness and supply chain recovery. During COVID-19, global supply chains were thrown into chaos. Microchip shortages, shipping delays, everything spiked. Automakers slashed production because they didn't expect demand to bounce back so fast. That scarcity drove up the average transaction price of new cars to roughly $47,000 to $48,000 plus. But now, supply chain issues are easing. Production is normalizing, meaning more cars are being made and shipped. With more inventory at dealerships, that power is shifting to buyers again. 2. Surging inventory, a huge red flag. According to TrueCar, via their Q1 2025 report, day supply for new vehicles is rising sharply. DriveTech reports that new vehicle inventory jumped 15% in mid-2025, pushing supply to an 82-day level on dealer lots. To put that in perspective, back when things were tight, day supply was often 30 to 40 days. Now, buyers have seriously more leverage. More cars just sitting unsold equals pressure to offer discounts, rebates, and aggressive financing. Why prices are about to plunge? Here are the main forces combining to drive a hard crash in new car prices, based on expert analysis. 1. Automaker incentives are going through the roof. Manufacturers are leaning heavily on cash rebates, 0% financing, and loyalty or conquest deals to clear inventory. According to DriveTech, incentives are now averaging 7 to 8% of transaction prices. That's the highest in years. Automakers are doing this instead of cutting the sticker because they want to protect long-term value, residuals. But these incentives don't last forever. As competition heats up, they could get even more aggressive. 2. Cooling demand. Thanks. Interest rates. Higher financing rates from central bank rate hikes are making monthly payments painful for many buyers. This reduces the number of people who can realistically afford a new car, pushing demand down. On the flip side, some analysts expect rate cuts in the near future, which would make financing more attractive, but those cuts might not offset other pricing pressures. 3. Overproduction. Market saturation. As production normalizes, automakers are flooding the market with vehicles. In some markets, like China, overcapacity is severe, with unsold cars piling up. Dealers are reportedly selling at massive losses just to move inventory. More cars, plus not enough buyers equals a classic supply glut, and when supply outpaces demand, prices fall fast. 4. Changing consumer behavior. Consumers are becoming more price sensitive. The average new car price has ballooned, making many people hesitant. Younger buyers, especially, are shifting towards shared mobility, subscriptions, or even delaying purchases. With EVs also growing more competitive, semis, gas-powered, buyers may wait for deals or drop out entirely. 5. Cost pressures and tariff uncertainty. There are new or increasing tariffs on imported vehicles, auto parts that some automakers are using to raise MSRPs. But this is a double-edged sword. While tariffs could push some prices up, they also risk depressing demand further. At the same time, insurance rates and fuel costs remain high, adding to the overall cost of ownership. High total ownership costs make incentives more attractive, but also mean fewer buyers are willing to stretch budgets. Big signs that the crash is underway. To make this real, here are major warning lights already flashing in the auto world, backed by data. 1. Inventory levels are historic. Q1 2025. TrueCar Motor Intelligence data shows a big jump in days supply. DriveTech 82-day supply, a major reversal from the tight market of recent years. 2. MSRPs holding, but incentives exploding. Automakers are not broadly cutting sticker prices. Instead, they're aggressively using rebates, 0% financing. This points to a strategy. Maintain brand value while still driving volume by targeting price-sensitive customers. 3. New vehicle prices starting to dip. According to TrueCar, Average list price in Q1 2025 fell to $47.3 thousand, down from $48.0 thousand a year earlier. That decline isn't massive yet, but combined with high inventory and incentives, the trend is worrisome for automakers. 4. Buyer leverage is returning. Because of excess stock, buyers now have more negotiating power than they've had since the pandemic. Dealers may start cutting deeper to make room for newer models or to hit quarterly targets. Possible scenarios. What could happen next? Here are 3 potential what-if scenarios for how this collapse could play out, and what that means for you as a buyer or market watcher. Scenario A. Soft crash plus deep discounts. Automakers dramatically increase incentives to clear lots. Long-term 0% financing. Huge cashbacks. MSRPs may not fall much, but effective transaction prices drop a lot because of these deals. Consumers who play it smart could lock in huge savings, especially if they wait for the right rebates. Risk. If rates hike again, demand could slide, killing auto sales volume. Scenario B. Hard crash plus MSRP cuts. Inventory continues to pile up. Automakers decide to drop base prices, MSRP, across many models. New cars lose value rapidly. Some don't hold their value well, turning into near-use status quickly. Resale values drop, making the ROI on new cars riskier, which could push even more people into used cars or leasing. Risk. Automakers could be forced to really slash prices if consumer demand doesn't match. Scenario C. Patchy crash plus regional risk. Certain regions or brands crash hard, while others, premium, niche, remain stable. Tariffs, production costs, and regional demand differences mean not all manufacturers or markets are affected equally. Some car makers, especially EV players, may absorb the shock, but ICE car makers could be hit harder. Risk. If tariffs or import costs skyrocket, prices could bounce back in some segments, creating volatility. Why you should care, and what you should do. For buyers, this could be the moment to play hardball. Negotiating cashback deals or 0% finance could save you thousands. For investors, auto stocks, parts manufacturers, this shift could create winners and losers. For car owners, if you've recently bought, depreciation might accelerate. If you're leasing, newer supply could affect your future lease value. Smart moves you can make. Wait, if you can. If you don't need to buy immediately, waiting for the discount wave could be massively beneficial. Keep an eye on incentives, end-of-quarter or end-of-year promotions. That's when dealers may be most desperate. Negotiate hard. Use the 82-day supply data or similar when talking to dealers. You have leverage. Ask for financing deals, trade-in bonuses, or catch rebates. Counterpoints and risks. What could go wrong with the crash theory? To be fair, there are risks to this crash thesis, things that could go against the price plunge scenario. Here are some counter-arguments. 1. Tariffs could reverse or shift. If governments change tariff policies, import costs could swing again. Automakers may absorb or pass on these costs selectively, muddying the pricing waters. 2. Rate cuts might not help enough. Even if the Fed cuts rates, financing might take time to become super attractive. Plus, other costs, insurance, maintenance, are still rising. Higher-risk borrowers may still be shut out, limiting demand. 3. Brand loyalty, premium cushion. Premium brands, luxury EV, may hold value better and resist price drops, reducing the crash's impact in that sector. Automakers didn't universally raise sticker prices preemptively. Some may rely on brand strength to weather the inventory storm. So, why are new car prices about to crash hard? Because supply is surging, demand is cooling, and automakers are handing out aggressive incentives. Put it all together, and you have everything you need for a classic bubble burst scenario. Thank you guys for watching. If you want more videos like this, make sure to like the video and hit the subscribe button, and we'll see you in the next video.